Today on the Joseph Carlson Show, the S&P 500 and the NASDAQ 100 are both up 20% year to date, and that is after racing up in 2023. In just the past 5 years, the S&P 500 is up double. The QQQ is up 155%. Many top stocks, like the ones in my portfolio, have also done really well. They've raced up to all new highs. And while it's nice to look at this and see the gains come in, it's also important to ask whether or not these companies are getting expensive. So today we're going to be looking at that question of the valuation of the stock market. We'll be looking at price to sales multiples, PE ratios, forward-looking indicators of the major market. We'll also be getting the opinions on different commentators of why they think the market is cheap or expensive. For example, Dan Niles believes the market is expensive, while you contrast that with both Tom Lee and Ed Yardeni, who both believe the market will continue going up. So we'll be going over all of that, and I'll be giving some thoughts on what I'm doing specifically, knowing that my portfolio is becoming more expensive. Now, we also have news of the China trade. Chinese stocks are doing well after the Chinese government has promised to do incredible levels of stimulus, in many ways trying to mimic what the US economy did. Many of the top Chinese stocks, like Alibaba, have surged over the past month, so it raises the question of whether or not we should try to take advantage of this stimulus. Is the government in China handing out free money that investors can scoop up, or is it better to steer clear? Now, we also have news of one of the most impactful strikes happening right now, led by this guy, wearing apparently $1,000 worth glasses and a $10,000 gold chain. He is the one striking for a big pay increase. And then finally, we have news that Meta's AI glasses are quickly being used to dox people live. We'll look into how this works and why I believe eventually these AI glasses will be used by the police. Now, obviously, we have a lot to get to in this episode. One quick mention before we jump in. It is the beginning of the month, which means that if you sign up for the Patreon, patreon.com/Joseph Carlson, you will get access to Qualtrim, which is this website. It's the stock analysis tool I use all the time. I've built it from the ground up. Qualtrim has all the financial statements in visual format. It has KPIs. These are unique things like Costco warehouses over time and other specific key performance indicators per company. It also has a watch list page that shows you how your companies are trading, shows which ones are currently in a dip. You can read earnings transcripts from every company. You simply just type in the stock and you have it right there in message format. The reason I bring it up is because if you join today, you'll get the entire month of October for free. It says $10 a month, but that is after a 1-month trial. We're getting close to 7,000 active users on it, and it continues to grow. We keep investing more and more into it. So try that out if you like. Now let's go ahead and move on and jump into the main story, which is that the market is getting up to near what I consider to be the expensive territory. You can call it expensive, you can call it overbought, you can call it overvalued. Whatever you want to call it, I think it all virtually means the same thing. That the market is towards that category where there's higher expectations for companies than what normal is. I have $1,100 that is all dividend money, and I want to deploy that cash. I want to reinvest it, but where should I put it? Well, there's a couple different thought processes of what to do in the situation where everything is seemingly looking overvalued and we have new money to deploy. Now, the first question we have to answer is if everything really is overvalued. We can do that by looking at historical averages. For example, this chart shows the S&P 500 in blue and the QQQ in purple. This is a chart of their forward price to earnings ratio over time. For example, we can look back in 2012 and 2013, buying stocks during this time period, where they're at an average PE ratio of 13 was super cheap. It was like shooting fish in a barrel. You could not miss. Now, over time, stock valuations and forward PE ratios of the overall indices started to go up, but rather slowly. From 2014 to 2020, they went from around a 13 forward PE ratio to around an 18. But then after COVID happened and record stimulus was pumped into the economy, people started paying anything for stocks. They were buying them hand over fist. They couldn't pay enough for them. Even companies that didn't have fundamentals to back them up. The S&P 500 got up to a 25 forward PE and the QQQ to a 30, so an average of around a 27 forward PE ratio. So we have both ends of the spectrum here. Now we know what happens after paying too much for something. The stock started to trade down. They re-rated. Many of the most expensive companies in the market went down. This was in conjunction with the decline of ARK Innovations ETF. Those type of funds were the ones that were the most severely damaged during this time period. Now there has since been a recovery from when it met its lows, and that's where we find ourselves today. Today, the QQQ is at a 25 forward PE ratio. The S&P 500 is at a 22 Forward PE ratio. So if you blended the two together, we're at around a 23 forward PE ratio. So the question is whether or not a 23 forward PE ratio is too expensive. One investor, Dan Niles, believes the answer to that question is yes. And he argues that instead of US investors doing well, the trade now is to move to China.
But yeah, I want to get longer China as we go forward, because if this is a fundamental shift in their way of thinking, we've seen what stimulus does in every other country on the planet. Unless you think a global pandemic is great for the world, the S&P shouldn't have been up 16% in 2020. So you know what stimulus can already do, and China has just refused to do it.
He makes a pretty straightforward argument, and I would say even a compelling argument. But there's other investors that believe it's not time to abandon the US markets.
That's right. I think we're still in the midst of a very tricky period because we've got the election in less than 35 days. And now we've got two things that investors don't know how to discount. One is mounting tensions in the Middle East, and then a port strike that is potentially going to cripple the economy. And so I think that as investors worry about this, if we get a dip, and a big dip, I think you still want to buy that dip because the setup into year end has a lot of tailwinds.
Tom believes that one of the big tailwinds is other investors buying the dip. Simply put, there's a lot of money sitting on the sidelines, and he's mentioned this for the past couple of years. Anytime there's a big dip in the market, investors will dip into their money market accounts and buy the dip. He also believes the S&P 500 could reach 6,000 by the end of the year, which is around $300 to $400 higher than it is today. Ed Yardeni also believes there's a good setup for the market to race higher.
I raised the odds of a just outright melt-up like something we had in the 1990s. I've been talking about it only a 20% probability, and I'm raising that to 30%. And then I still have 50% in what I call the roaring 2020s. So that's 80% that we're in a bull market. The 20% I kind of leave for a 1970s scenario as a result of geopolitical risk.
So he factors in the geopolitical risks, but still believes there's an 80% chance of the market going higher. And I must say, when I look at these different takes, I agree with Ed Yardeni and Tom Lee. I disagree with Dan Niles in jumping into the China trade. And it seems like the media is trying to push me that direction. In fact, when I look at different outlets like Bloomberg, it highlights over and over again the Chinese stimulus, Chinese stocks soaring more than 7%. We see it talked about nonstop on CNBC. All these investors jumping into Chinese equities. Barron's is another outlet that's made a lot of their top stock picks for 2024 Chinese stocks, and so far those ones have done really well. They say that the China trade is still thriving. It's easy to understand the logic behind this trade. US stocks are looking expensive, Chinese stocks look cheap, and China is now doing stimulus. And this is something that there's a heavily split opinion on. David Tepper, one of the legendary fund managers, just said a couple days ago to, quote, buy everything in China. Now, when you have somebody as respectable as David Tepper saying this, obviously that stirs a lot of opinions. So now there's a lot of traders rushing in to buy China. Even so, I'm not following this trade, and I don't think anybody explains the risks better than Kyle Bass, someone that's been continually right on the risks of investing in China for years.
Yeah, great to be here, Andrew. I think that look, Tepper is one of the best hedge fund investors in the history of our markets, and he's a great trader. And we say something at our firm. We say, you can't break your arm jumping out of the basement window. Chinese stocks have been up only 5 of the last 20 years. Their GDP's up 505% reportedly. And if you invested in their Shanghai Shenzhen 300 index 15 years ago, you're still not making money, even though stocks are up 25% in just a week. So you've got a policy-driven stimulus, you've got animal spirits arisen, but typically the biggest rallies are counter-trend rallies. And China's trend has just been down for so many years, Andrew, as they've shown as Xi Jinping has kind of shown his hand. Investing in communism has never worked in the long run.
So your argument.
Now, he's interrupted there, but the end of that exchange, he says that investing in communism has never worked in the long run. And that is one of the biggest problems with China, is the level of distrust with the way that they run their government. For example, one of the things that caused a lot of concerns investing in Alibaba was Jack Ma going missing after criticizing the Chinese government publicly in an interview. Those type of things do not build trust in the government. And Kyle Bass is correct in giving the track record of China. There's no other way to say it than Chinese stocks have been a terrible investment for a long period of time. Here's a chart of the Chinese large cap ETF going back to 2004. Now, it starts off in 2004, it goes up in a big rally up until 2007, and then it falls. But unlike the US, where it recovered and continually grew throughout time, investors did really well for the next 20 years, the Chinese large cap ETF today is still below half of where it was in 2007. And it's not just 2007, it's also well below where it was in 2021 or 2018, 2014, 2010. This has been a bad investment for the past 20 years. Now, you could argue that maybe this is the time to buy. It's been so low for so long, you're getting these stocks at a great deal. But he also doesn't believe that that's the case.
They got stocks up. Think about this, Andrew. 25% in 1 week. And so, is that a good time to buy something? I would argue that this has been a trading rally. It's been a massive counter trend rally. But think about 2014. Think about many years before. Their stock market sits today where it was a year ago, where it was in 2016, where it was in 2009, where it was in 2006. That's exactly where we sit today. And so if their GDP is up 505% and you're still sitting where you were sitting back in 2006, I don't know, maybe you should consider not investing in communism. Do I think that the rally could continue? Do I think that stocks could go up more? The answer is yes, but I equate it to picking up dimes in front of bulldozers.
Investors can pick whatever side they want on this, but Kyle Bass has the historical data to support his argument. Anytime Chinese stocks have surged, that's been quickly followed by them going nowhere for a long period of time. So in many ways, this feels like that meme where you're deciding between two choices, one of them being overpriced US stocks or China stocks. A difficult choice, but even given this scenario, where you're looking at stock prices in the US and feeling like they're a little expensive, I'd still rather make that choice. I still think the risk and reward is better. First of all, it's debatable how overpriced US stocks really are. That all depends on future growth. In many cases, stocks can outgrow expectations to a huge extent. That's why when we actually look at most data of the S&P 500, if you bought it during market highs, during time periods where it just broke all-time highs, you actually did quite well. In fact, you did better buying the market at all-time highs rather than investing on any average day. That's because you're buying the market during times of momentum. And this is the reverse psychology that gets a lot of investors in trouble. It's better if we disconnect from all anchoring bias. If instead of focusing on how much stocks have gone up, we focus on buying quality companies that still have a very bright future. So the answer of whether or not I'm investing in Chinese stocks is no. I think Chinese people are great, they're hardworking and trustworthy, but unfortunately the system of government is not one that I can put my trust behind with large amounts of capital. And in terms of what specific companies I'm buying, that's where things get really difficult. Right now in my portfolio, there's not any company on any significant dip. So there's no easy buy in the portfolio. And in situations like this, what I plan on doing is simply just waiting a little. I'm going to try to accumulate a little bit more cash through both dividends and deposits and wait until earnings season. Typically in earnings season, out of the 12 companies in this portfolio, a couple of them will have some negative earnings reaction and go down a few percentage points. If that happens, that'll be a buying opportunity to deploy these dividends. Now moving on, we get to news that you've heard about all week. It's the port strikes from Maine to Texas. The ports are where you ship in those large shipping containers. It's part of our logistics chain. It's part of our supply chain. It's what moves things around from one continent to another. And while these are being shut down, that causes inflation. Inflation is when you have more demand for something than supply. So having a strike at the ports reduces supply and increases demand, causing inflation in almost everything. From common goods to oil to all sorts of commodities, every single thing you can think of starts to become more expensive because of these strikes. So this is something that's not a small strike. It's not like something that we can just ignore. This is going to have a real impact on a lot of people. The country is going to be worse off from it. There's new analysis coming out that's saying the port strikes could reignite inflation. Economic impacts are dependent on how long it lasts. Christopher Ball says if it goes for a week or two, you're running into businesses that have real shortages. And yeah, they'll absolutely have to raise those prices just to prevent broad shortages of those goods. And of course, this happens right after the Federal Reserve cut interest rates by 50 basis points. The worst thing that could happen for the Federal Reserve is for inflation to start trending back up. That could potentially impact the soft landing they're looking for. So we know what's at stake here. This isn't something that's going to completely shut down the economy. People shouldn't be entirely fearful because of these strikes. There's still other ports that are open right now, but this does impact the economy in a negative way. It raises prices across the board, and it could reignite inflation to some degree. None of that is good for the US, for customers, for investors. Now, this is also a story where, unfortunately, the more that you read about this and the more that you research it, you just become more and more upset at why they're striking and specifically what they're asking for. This is one of those stories where just the more you dive into it, the more irritating it becomes. First of all, the guy behind the strike is the leader of the International Longshoremen's Association. His name is Harold Daggett. Now, we'll talk about Harold here in just a minute, but I first want to go over what they're asking. This is from the Wall Street Journal. So this is vetted. This is specifically from the union. This is what they're actually asking. And I have to preface that because of how ridiculous it is. Daggett rejected an offer late Monday of a 50% wage increase over 6 years, a boost from an earlier proposed 40% wage increase. That's correct. He already rejected an offer of a 50% wage increase over a 6-year period. Now we go on to what they want. And this is where things just get mind-blowing. The ILA, which is the International Longshoremen Association, want to raise the base hourly rate for its roughly 45,000 members from $39 per hour to $69. So they're wanting to raise their base rate for every single member and every single role. Now, know that not all of them do the same job, so some of them have less difficult jobs than others, but they want to raise it from roughly $40 per hour, which is almost 6 figures per year, to $70 per hour, which is well in excess of $100,000 per year based on full-time work. That is a 77% pay increase over 6 years. So they're shutting down part of logistics, part of US commerce, threatening to reignite inflation to get a pay increase. This is essentially holding the US hostage to get a massive pay increase. And this is where we have a problem with some unions. Unions are meant to protect exploited workers, workers that are disadvantaged, being taken advantage of by large corporations that don't have a voice themselves. So there's a union that helps represent them and barter for their good. But unions aren't supposed to be a mechanism whereby a large organization can extort the rest of the country into giving themselves massive above-market pay increases. A big part of the issue here is that a lot of that 77% increase in pay would go to workers already making well in excess of $100,000 per year. These are already well-paid workers wanting to make almost double. Now, like I said, we'd be hearing more about Harold Daggett in a minute. He is the leader of this union, the one that's already turned down 2 different generous offers for pay increases, and he's going for that 77% pay increase. Here's what he has to say regarding the strike.
Are you worried that this strike is going to hurt the everyday American, the farmers that need to reach the export market? They're telling me that they're going to hurt through all of this.
Now you start to realize who the longshoremen are, right?
Nobody cares.
People never gave a about us until now, when they finally realized that the chain is being broke now. Cars won't come in. Food won't come in. Clothing won't come in. You know how many people depend on our jobs? Half the world.
He says that people never cared about us until now, which in a way is true. I guess people aren't actively thinking about port workers on a daily basis. That's not something that you normally wake up and go, wow, I really care about the port workers today. But that's not a normal thing for people to do with any industry. No matter what job you're working, not everyone in the world is focused on the job that you're doing, no matter how integral it is to the economy. People think about what he's doing, obviously, because they're compensating him and the union members for doing it, many of them making above $100,000 per year. And further, if we look at this interview in and of itself, this union leader himself exemplifies greed in every way possible. For example, we have the detectives at TikTok, one of them pointing out that in his interviews, he's wearing glasses that have a very unique band. Around that band, you can identify what type of glasses they are. They are 24 karat gold plated rimless butterfly sunglasses that retail for $1,245. On his neck, he also has a chain. That chain is a 14 karat yellow gold railroad chain necklace. It retails for around $10,000. This union leader, while pretending to be taken advantage of, is apparently blinged out in high fashion. Now you could say, hey Joseph, maybe he's just one of those people that has expensive tastes and likes having a few nice things that he saved up a long time period for. Well, that could have been the case, but as people looked more into the life of this union leader, claiming that he's going to shut down the economy, hurt American people, cause inflation, all for a 77% pay increase, well, it turns out that he's not someone that just likes high fashion. He just has a lot of money. He owns a 7,000 square foot mansion. This mansion is located on a 10-acre property in Sparta, a leafy enclave 50 miles west of New York City. It encircles a spacious backyard patio with a pool. It's difficult to really visualize what a 7,000 square foot mansion looks like, so we get an aerial view to see it better. And you can see the eloquence, the expansiveness, the impressiveness of this property. I will say one thing. This union leader has good taste. This is an impressive house that anyone would be envious of. This is a property that, according to Zillow, is worth at least $6 million. Now again, this is all owned by a guy that just recently said in an interview, quote, "I will cripple you. I will cripple you, and you have no idea what that means." Nobody does. The Wall Street Journal reported that when he was asked how long the strikes would last, he said, quote, "I don't have an effing crystal ball between my legs, but it will last for very long. I would tell you that." So this union's led by someone that has extravagant taste for wealth and shows his bling while in interviews advocating for his union members to have nearly double in pay, many of them making over $100,000 per year already. And they're not only asking for a pay increase, they're also demanding that we can't automate our ports. Port automation is exactly what it sounds like. We use robots to make ports automated. They're safer, they're more efficient, they work harder, and they're cheaper. And we have ports already doing this in California.
Our Stu Mundell over the Port of Los Angeles, seeing something unfold many folks probably didn't know about. The port is going automated. Artificial intelligence and digital technology are moving and powering commerce here.
These are drones.
Containers are lowered onto trailers, and within seconds those trucks drive off. They know where to turn, where to drive, and where to drop off their cargo. They even yield to each other when one crosses in front of the other, and there are no humans in sight.
Obviously, this is really cool. Seeing ports automated like this is awesome, but the union on strike right now doesn't like this. They don't like it one bit, and in fact, they're demanding that you can't do this with the ports they work out. On a side note, the automated ports that China has been developing are so much more efficient that they work for a fraction of the cost while getting more done, and more importantly, they run 24/7. Unlike US ports that have to stop whenever the employees go home. These ports continue working, which means that people can ship things in at any hour of the day. So as I said, this is one of those stories that the more I learned about the topic, the more it becomes frustrating to understand what they're really asking for. 77% increase in pay for a leader that is a multimillionaire and already makes $800,000 per year. And while wanting that pay increase, they're also demanding that the US cannot innovate and develop further automation on their ports. How long will this strike last? How much damage will it cost? Right now, we don't know. But so far, it's not looking good. Now moving on, we get to the story that we know Meta has been developing augmented reality glasses. This is one of the groundbreaking changes they came out with, a new platform, as Mark Zuckerberg calls it. But there's been somewhat of a problem or a potential side effect of their already existing Ray-Ban sunglasses. And that is that people have used them in combination of other techniques to instantaneously dox people in real life.
To use it, you just put the glasses on, then as you walk by people, the glasses will detect when somebody's face is in frame. This photo is used to analyze them, and after a few seconds, their personal information pops up on your phone.
Right? This is me, June Lee, right?
Yeah.
This
photo was great. This is like...
You're from Bergen County Academies?
Yeah.
Your Korean name is Ju Yoon?
So basically, they just wrote a simple program where the glasses are constantly scanning people because they have a live video feed. Once they get a clear enough image, it detects the face, it plugs it into AI, then within a couple seconds, you know everything about this person's history. Now, obviously, this can be done in private locations, in public locations. It can be done in businesses without you knowing. As long as someone's wearing sunglasses and they just look at you, they could potentially know everything about you, everything that's publicly online, or even things deep in your past buried online somewhere throughout the web. They say that privacy has always been a major concern with smart glasses. Google Glass originally failed due in part to public backlash at being recorded without consent in public places. Now, Meta tried to address this by including a privacy light that automatically turns on whenever you're recording video. So that was Meta's big solution. They're saying, people are concerned that they're going to be recorded all the time and they don't like that invasion of privacy. Well, we'll just turn on a little light on the frame of the glasses whenever it's recording, because people will never figure out how to turn that light off or how to simply cover it. Another problem with that light is it's incredibly difficult to notice when you're outside in bright light. So you can simply be outside and most people are still not going to even notice a tiny little LED light on. Although they're cool and it's a new innovative platform that Meta's leaning heavily into, this is another erosion of our general privacy. We know that everything we do whenever we go outside is going to be recorded. It's going to be looked up in databases. There's going to be facial recognition technology used against us. Another big use case I believe will happen from this is police force. I think the police will be very interested in having glasses that anytime they look at anyone, it IDs who they're looking at. It looks up all of their historical information, and then they could integrate that into a background check. They could see all their priors while just looking at their face. So whether or not Meta wants to work with the police, whether or not they decide to, eventually someone's going to. So while I see this as another big platform, I think there is huge advantages to augmented reality. I also think there's going to be some severe disadvantages. But those are just my thoughts. We'll see how things develop. That's all for now. See you in the next one.